Welcome to Author's Note. I'm here to talk about the UK economy this week, after the downgrade that Moody's gave UK sovereign debt last week, giving a blow to George Osborne's political hopes of maintaining the AAA credit rating. With me is Kevin Daly, UK economist of Goldman Sachs. Now Kevin, what effect has the downgrade actually had this week?
Well, on markets it's had very little effect. Gilt yields are largely unchanged, equities continue to do quite well. Where you have seen the biggest effect has been on the sterling exchange rate, which did weaken as a result of the downgrade, and has indeed weakened by around 6% since the beginning of this year, largely as a result of a change in the Bank of England's reaction function and related to that the anticipation of more easing.
Now, when you talk about the exchange rate easing, I think you've got a chart to show us about what effect this has. I think here it is. Here's a chart about the financial conditions. This is one of your own bespoke charts. Can you explain what exactly it's showing?
So this is our UK Financial Conditions Index, which includes short-term interest rates, 10-year corporate bond rates, the trade-weighted exchange rate and equity prices, combined into a single index to give an overall sense of UK financial conditions. And largely as a result of the weakening in the exchange rate, but also due to the rally in equity prices, it has eased pretty dramatically at the start of this year. It is down in around 150 basis points here, which all else equal should boost real GDP over a period of 2 years by around 1 to 1.5 percentage points, so quite a decent boost.
So this is really quite a lot of easing that's happened anyway without the Bank of England changing policy or the government changing policy in any meaningful way.
Exactly. It is in anticipation of the changes that will take place, in anticipation of an easier stance under Carney, and indeed changes that have taken place or appear to be taking place even before Mark Carney arrives as the new governor of the Bank of England.
So I see, if we've got financial conditions that have certainly got easier, mostly because the exchange rate has fallen rapidly this year, I think if we see the second chart, we can look at interest rates. We see there the blue line, bank rate, the official rate of the Bank of England, which hasn't moved since early 2009, and then private sector rates, which also haven't come down very far yet. So this sort of suggests that maybe financial conditions haven't eased so much. When people want to borrow, they're still having to pay the same amount.
Well, in terms of the interest rates that are effective interest rates in the broader economy, they have remained stubbornly high, despite bank rate being, as you say, at the floor, and despite 25% of GDP in terms of QE. The effective rate, so that the rates that banks lend to households and corporates, has remained close to 4%. And has shown little sign of easing. And this is precisely why the Bank of England has engaged in the funding for lending scheme, why they are moving away from conventional quantitative easing, so the purchase of gilts, towards credit easing policies such as the funding for lending scheme, which will help to drive this lower. Now, we think the early signs are that this is beginning to have some traction in driving effective rates lower. It doesn't yet show up in this chart, but the anecdotal evidence from high street lenders is that rates are coming down.
Why are we all so pessimistic about the UK economy? Why is Moody's downgrading our sovereign debt? What's, you know, all this good news about? What's there to counter that?
Well, we are a little bit more optimistic than consensus on growth. We have 1.4% growth for this year versus a consensus of in around 1%. But as you say, I mean, the question is why, you know, given these positives that we highlight, aren't we even more optimistic? And the reason is that there are still some pretty significant negatives for the UK economy. So the negative effect of the fiscal drag, which will still be a significant drag this year as it was last year. And also in addition to that, the weakness of the euro area. We still have the euro area in recession. The euro area accounts for 16% of UK GDP in terms of trade. So there's quite a significant direct drag on the UK economy.
Thank you very much, Kevin. Well, there you have it. The financial conditions of the economy have got easier, and this should help growth this year. But there are a lot of headwinds still to come. For more information and analysis, keep watching on ft.com.